I invest in dividend-paying stocks that produce cash flow, dividends that I can use to pay my bills. I employ a relatively simple, straightforward strategy, a relatively low-risk strategy, in my humble opinion, and based on the data that I just analyzed, I am actually beating the S&P 500. So that is correct. I am beating the S&P 500, not by a huge margin, but by a slim margin. But I'm going to discuss in today's video how I arrived at this calculation. I know there are a lot of skeptics out there, a lot of people that don't like the dividend strategy. They think that growth stocks are the only way to go. And look, I am not here to debate strategies at all. I am one that wishes everyone well. If someone's a pure growth investor, they only buy growth stocks like Tesla, for example. I wish those investors well. And quite frankly, I know a lot of those investors, they've been doing extremely well. There are other strategies out there, such as active trading or even day trading. I wish those traders, those investors, well as well. For me, I like the dividend strategy because it works for me. I want to live off of my dividends. I want to use my dividends to pay the bills. And I like the lower risk that is associated with the dividend strategy. So the dividend strategy, it works for me. I'm not saying it's the best strategy. I'm not saying it's the only strategy. And like I said, I wish everyone well. But I want to share today some math, some figures that I calculated that explain how I have been beating the S&P 500. I think you guys are going to enjoy this because this is actually a subscriber request. I just did a video that I will link in my description below that shows my total returns. It shows my total returns, my yield on cost, and as soon as I published that video, I got all kinds of comments pouring in from the community. Ian, this is interesting data, but how does it compare to the benchmark? And what were the dates in which you purchased these stocks? And so I'm sharing today the dates in which I purchased each stock. I'm sharing how it compares to the S&P 500 and how I arrived at this analysis on the whiteboard here. By the way, you may want to pause the video right now if you are not already a member of my email list for my dividend stock portfolio. If you are already a member of that list, you should have already received an email already. I sent an email to that list just before publishing this video so that you can have my entire Excel spreadsheet in front of you. This is a really cool Excel spreadsheet that goes into a lot more depth than I could fit on the whiteboard here. But if you are not a member of that list yet, check out the description below. I will include a link where you can sign up. And once you do that, you will receive an email. You will have to opt in. Once you opt into that email, you will receive another email with a link to download the analysis that I'm sharing today. And quite frankly, some other links to download some other cool stuff as well. And so, by the way, if you don't get the emails, they're not coming through properly, make sure you check all of your folders, including the junk or spam folder. Sometimes the emails may end up there. And so I just want to make sure everyone has this analysis in front of them before we dig into these numbers today, because this actually is probably the most complex analysis that I've ever shared on this channel here. So you really want to have this in front of you before going through the video today. And so I'm going to give you a minute to download that analysis, get it in front of you if you haven't already, and then I will see you on the other side as we dig through these numbers, and you get to see how I've actually beaten the S&P 500. All right, everyone, so let's get started. So I'm just going to give a very high-level breakdown of how I did this analysis. And so basically, I have built my dividend stock portfolio really heavily over the course of the last 10 years. I've been investing for over 20 years, but in my early days, a lot of those stocks that I bought, I actually had to sell them to fund the down payment of our first home, and then later when we moved, to fund the down payment of our second home. So really, I, right now, have been building the portfolio that I have now for about 10 years' time, but I have been investing in dividends and the stock market for over 20 years. And so anyways, the first thing you'll notice when you look at the spreadsheet is I'm going to share with all of you not only my top 15 stocks, not only my purchase price of each of those top 15 stocks, first tranche, but I also share the date, the precise date in which I made the trade. Now, this analysis is full of assumptions. I'm not going to say it's perfect. It's far from perfect, but this analysis is supposed to be directional. It's supposed to be proof to myself and others out there that, hey, this dividend strategy, it's actually pretty cool. It's actually pretty darn cool. But look, if you pick this apart, you're going to find assumptions in there. You're going to find probably ways to look at it differently, and that is all good. I am just trying to share a basic analysis here that compares versus the S&P. So anyways, I include the date, the trade dates that I made each of my first tranche purchases. And assumption 1 is I'm only sharing my top 15 stocks. I didn't want to do this for all 40. And also, I'm only doing the first tranche. If you've been following me, you know that I like to average in. I don't buy all of my shares at once. I like to buy here, start a position, and then as time progresses, I keep buying more. I average in. So I'm only looking at my first tranche here. And so that's assumption number 1. And I want everyone to be very clear about that is an assumption that may or may not change the results of this analysis. I don't know because I've not done the analysis with all of the tranches. I just have not had the time to do that. Maybe one day I will. I hope I have the time one day, but right now I want everyone to realize this is just a side hustle for me. I have a full-time job, and so I have to focus on that. I spend the limited free time that I have on YouTube when I'm not spending time with my beautiful wife and my 2 kids and my family, and so that is one of the reasons that I have to make some of these simplifying assumptions. So once I look at the trade dates of each of my first tranches, what I did is I went to Yahoo Finance. And so you'll see in the spreadsheet, I have a column for the S&P 500. And I looked on Yahoo Finance. It's really helpful because it has historical data for the S&P 500. And I looked, Ian, what is the S&P 500 on the day? What did it open at on the day that I made my first tranche purchase? I record all of that information. Then later in the analysis, what I do is I look, okay, let's look at the present day. I think I did this on April 11th. That was the date that I used for my analysis because that's the same day that I used for my last analysis in the video. I'll link in the description below to the video where I show my total returns. Just want to keep it consistent. Anyways, I look on the present day what the value of the stock is and what the S&P 500 is at as well. And I look at the delta. Okay, in terms of capital appreciation, how much am I up on the stock? That's what I shared in the last video, by the way. But I also look, okay, how much is the S&P 500 up in terms of capital appreciation? Now, worth noting, stock charts in general, they don't include the element, the concept of the dividend. And as we know, the S&P 500 provides a dividend, and all the stocks I own provide a dividend as well. And so we'll get to that in a minute. But anyways, what I first do is I literally look, here's my trade date, here's the present day, what was the stock where I bought it, what is it at now, what was the S&P on the same day I bought, what's it at now, and I compare, I look, okay, how much are each up? Now, what I also do to make this analysis work, because I have to add in the element of dividends, because dividends are an important part of my return, they're an important part of the S&P's return, is I have to normalize things a bit. And so what I do is I look at the compound annual growth rate. And so there's a formula where one can take a total return, and if they know how many years it took to make that total return, they can extrapolate it down on average for each year, what was the rate of growth, what was the return. And so I use the compound average growth rate formula both on my returns for each stock. Mind you, I do this stock by stock, and then I also use the same formula for the S&P 500 as well. And so I back in to the compound annual growth rate for both the stock I own and the S&P. Now, as you look at my spreadsheet and you look at the formula, it changes a little bit from stock to stock. And the reason it changes is each of these, when I look at tranche 1 of each of these, they were purchased on different dates. And so I have to, some of them I've owned, for 8 years, some for 1 year, some for 2 years, and in between. And so the compound annual average growth rate formula it will change slightly, just very slightly, to take into account the different time periods in which I've held each position. And quite frankly, the S&P comparable, how long that I would have held that hypothetically if I owned that. And so once I extrapolate down to a number, I get a number that shows, okay, here's my compound annual growth rate for the stock. Here it is for the S&P for the comparable period. What I do is I look at the current dividend yield. What is the current dividend yield of the stock? Johnson & Johnson, for example. What is the current dividend yield of the S&P 500? I take the compound annual growth rate for the stock and I add in the current dividend yield to it. I take the compound annual growth rate for the S&P 500 and I do the same. I add the compound annual growth rate of the S&P 500. I take the current yield, I add it to it. Now, why do I do this? This is symbolic of the total return. Mind you, the total return, both for my dividend stocks and for the S&P, it's not just capital appreciation. It's not just the chart. What are the dividends that come in on top of that? Both the S&P and my dividend stocks pay dividends. Now, my dividend yield, the average for my top 15, it's a lot higher than the S&P. And so you'll see before I include dividends, the S&P is looking pretty good. On a capital appreciation basis, on a chart basis, S&P is looking pretty darn good. But when I add in the dividends, I inch ahead of the S&P. And so one important assumption here is I don't go back in time and I don't look like over time, what was the yield of J&J versus the S&P and how did it change over time? No, that would have made this analysis way too complex. What I do instead is I just look, current dividend yield for J&J, current dividend yield for the S&P, add them in. And the reason I do that is I'm just assuming the spread, the difference between what J&J is yielding now and what the S&P is yielding now, more or less that spread, that's what matters, quite frankly. It's been somewhat consistent over the years. Now, that is an assumption, but I had to make that assumption to make this analysis possible. So I'm just trying to be very transparent here as I go through the analysis, the types of assumptions I'm making, because it's important. And like I said, it's not a perfect analysis, but it's the best I can do given the time that I have and given the requests that I have coming in to really benchmark this against the S&P. How is it doing? And so anyways, once I have all this done, I'm done. I basically have a total return number. I know what my total return is on average per year for the dividend stock when it includes the capital appreciation and the dividend, and I know the same for the S&P 500. And you'll see in the spreadsheet, I list it line by line by line, row by row by row, and you can compare the two numbers and you'll see in certain cases, the dividend strategy did better. In certain cases, the S&P did better. In certain cases, they're kind of close. They're pretty close. And anyways, I want to go through those really quickly, really quickly. But J&J, for example, when I have the compound annual growth rate plus the current yield for my first tranche, I get a 13.75% return yearly on average. S&P during the same time period, including capital appreciation and the dividend, the current dividend of the S&P, I get a 12.49%. So I have the arrow here pointing up. What that signifies is, hey, for this stock, my number one stock, my biggest holding, I have surpassed the S&P 500. I've done better than the S&P 500. But let's go on. Pepsi, 11.46% for my return on average per year for Pepsi. Again, with the dividend and the capital appreciation. S&P, the comparable is a 12.25. So they're kind of close. Maybe I should have put a down arrow, but I kind of put it even. I said this is kind of close enough. Look, it's less than 1% difference, 1 percentage point. So I say that they're even. Going on, McDonald's. I'm really doing better than the S&P. I love this one because a lot of people, they put down McDonald's. They think it's a thing of the past. I love McDonald's. Did you know, even though McDonald's these days, most of their restaurants are franchised out, McDonald's still owns the land and they play landlord. They actually receive lease payments, rental income from the franchisee. It's amazing, amazing business model. Anyways, 14.97% for McDonald's. This is my second best performing stock out of everything on here. And 12.77 for the S&P. And so I have an up arrow, McDonald's won. My number 4 favorite stock of all time, United Technologies, it's not done as well as the S&P for the time period that I have owned the stock. United Tech, 7.83%. S&P is 11.83. And so I put a down arrow. S&P has crushed United Tech. Thankfully, United Tech, it's not really the biggest position for me. You guys know this who have been following me a while. By the way, in the emails you get from me, you'll be able to download my whole portfolio, all 40 stocks, actually 39 at the time I did the portfolio, but you'll see the percentage allocation I have to each. You'll see how United Tech is a little smaller. By the way, I'm just going to share this now. Another assumption. I don't weight this analysis. At the end of the day, I take all of this data and I do simple average. That's another assumption. The weighting, quite frankly, would probably make my dividend strategy look even better because it would weight heavy towards stocks like J&J and McDonald's that are really big percentages of my portfolio. But just to keep things simple, I just do a simple average. I actually believe that's a more conservative way to model it, and quite frankly, that lowers the returns to the dividend stock portfolio, I believe. And so moving on, Clorox, I did a 13.21% on average per year, 11.94 for the S&P. So Clorox gets an up arrow. Clorox beat the S&P pretty handsomely. Duke Energy, I put a star next to this one. Duke, if you go back, there's going to be people that do this. I know this. It's so funny. A lot of people requesting that I did this video came from a great place, and I love you guys. I got nothing but love for you, and that's why I'm doing this. But some of the people asking for this analysis, it was one person was saying I'm making up the numbers, and you can't trust them unless they're audited by KPMG. Look. Like I said, I have a full-time job. I am just sharing this on YouTube for fun, and so I am doing my best with my analysis. Maybe there are mistakes in here. Maybe I do need KPMG to audit it, but I cannot afford as a small-time individual investor to go to KPMG and hire them to audit my numbers for the purposes of a YouTube video. But what I want to point out is there's going to be people that go through this numbers, and they're going to be like, wait a minute, I looked at Duke on the day you bought it, and the price is not accurate. Here is why. I came into Duke through Progress Energy. I owned a company called Progress Energy. Progress Energy was purchased by Duke, and so the reason my cost basis is different than the one that Duke signifies on the day that the day I'm looking at, the date of tranche 1, is because I didn't buy Duke that day. I bought Progress Energy, and so I got an extra lift. I got a better return because of that. But anyways, Duke was a 12.32% and S&P 13.13. So it's kind of neutral. It's you know, maybe I should have put a down arrow, but I felt like less than 1 percentage point difference. They're pretty close. Now, what's interesting, and I'm going to point this out, is I'm going to go into this more later. This is funny. The S&P 500, if you look at the top 10 stocks, they actually make up 20% of the S&P 500, thereabouts. I'll go through some of these later. A lot of these stocks are tech stocks, riskier stocks. And so what's funny is I'm beating the S&P. You'll see, look, I'll just go into it. The simple average for my portfolio for the top 15 for tranche 1 is 11.99% compound annual growth rate plus current dividend yield. Again, some simplifying assumptions in there, but that is the number I come up with is an 11.99. I get an 11.68 for the S&P, so I'm slightly above the S&P. If you looked at this a few years ago, I would have been probably further ahead of the S&P. If you looked at this in my early days when 100% of my portfolio was in sin stocks, I would have been way ahead of the S&P. Quite frankly, going forward, I think that I may underperform the S&P, and I am okay with that. The S&P to me does not have a huge significance. What has huge significance to me is being able to pay my bills with dividends. That's why I'm going this strategy, because of yield on cost. I talked about this in my last video. I'm not talking about it as much today because yield on cost is what I can use to really measure how much yield I'm getting from my investments, and I want to use the dividends to pay bills. I don't care about capital appreciation, but everyone else does. Everyone else does, and Vanguard does, and these mutual fund companies do, and so everyone has subscribed to this model, S&P, I've got to beat the S&P, and so that's why I'm looking at it this way. But anyways, what I do want to point out is I've got some really conservative stocks in here. If you look at the top 10 in the S&P, there's only one stock in this analysis that overlaps. That is Johnson & Johnson. The rest of mine aren't even in the top 10 of the S&P. Now, I do own one of the stocks in the top 10 of the S&P, Apple, but that doesn't make this because it's in my top 40. It's in my 40 stock portfolio. It's not in my top 15. In terms of full disclosure, I am long Apple, ticker symbol AAPL. I own that one. Anyways, what I'm trying to say is I'm carrying a lot less risk here than the S&P. I imagine in the next downturn, the next crash, which may be coming sooner than later, I will probably outperform the S&P. This delta will probably get bigger. But if this bull market continues, if the tech stocks, the stocks, a lot of them without earnings, continue to skyrocket, I may dip below the S&P, and I'm okay with either scenario because I am always adjusting for risk. And I have built a portfolio that carries the level of risk that I feel comfortable with, and it aligns with my values of paying my bills with cash flow. That may not be your values. You may have another strategy that is, I know I have one person commenting here saying they have done 30% returns per year on average. Now, I'm not going to dispute it. If you can do that, man, you're one of the best investors ever. I'm very happy for you. The only thing I would say is that may not be sustainable forever. When the next crash comes, the next downturn comes, it may be difficult to replicate that success over and over. But I would say more or less my success, I'd say it's pretty steady Eddie. I've got a pretty robust portfolio. Most industries, I would say it's a very defensive portfolio, very conservative portfolio, as compared to the S&P, which I would say is a little more aggressive and carries more risk, I believe, than what I have. And the leading indicator of that is my my number 6 stock. My number 6 favorite stock is a utility. And we all know that utilities are likely not going to beat the S&P. And quite frankly, it's even funnier. I end up beating the S&P, but I've got a utility, Duke. I've got a real estate investment trust, Realty Income. I've got another utility, Southern. I've got a lot of conservative stuff in here, yet I still manage to beat the S&P. And so that is another point to take home. I think it's really cool, really illustrates, puts a light on this strategy that it is, at least as far as I've been doing, it has been working pretty well. So moving on, let's go to the next one. Talked about Duke, Realty Income. I'm up 12.69% on average per year with adding in the dividend, the current yield. S&P 11.15. So I give it an up arrow because I'm beating the index there. I'm going to go quicker here. Procter & Gamble. I love this one because they're controversial. It's fun. Anyways, they're losing. They're losing. They've been doing recently well. They're losing only 9.86 versus 12.23 for the S&P. So down arrow. Coca-Cola loser 8.6 versus 12.77. 3M basically even 11.39 versus 11.9. Here's a fun one, Starbucks. I've been doing really well in this one. On average, 15.39. Actually, I was wrong. That's my second best performer other than Altria. I guess McDonald's is number 3. Anyways, Starbucks, S&P comparable is a 9.77. So you're seeing some interesting data here. Here's a fun one, Cedar Fair, ticker symbol FUN, recent addition, one I started buying 2018. I love this stock. The capital appreciation here wasn't much, it's only like 3%, but the reason it gets to 10% is because I got that juicy 7% dividend. So I've owned it for about a year, first tranche. The capital appreciation over that time has been 3%, but again, I'm adding in my dividend, and when I add the two together, the annual dividend, by the way, 10% versus a 3.6 for the S&P. That's where dividend really makes a difference. Mind you, one thing I want to point out here, I'm not assuming any reinvestment. If I assumed reinvested dividends, my strategy would be doing even better than the S&P here simply because I got a heavy weight on dividends, where S&P's got dividends, but they're smaller. So if I'm compounding and reinvesting my dividends and I'm doing the same with the S&P, because my dividends are bigger, it will skew the two apart even further, and so it'll push my strategy ahead even more. Didn't do it, just kept it simple. Assume that each year the dividend component, I'm just taking it and putting it aside in cash, or I'm spending it. Same with the S&P, taking the dividend, cash, whatever. Moving on, Altria. Talked about this in the last one, my best performing stock. I had another one, Reynolds American. This is what's interesting. Before they were bought out by BTI, in terms of full disclosure, I'm long BTI. I own that stock in my personal stock portfolio. But I was doing really well on that. And so the fact of the matter here is, in the early days, I did a video on this. It was real controversial. People didn't believe me. That's why I'm sharing the data now and the spreadsheet. But I was really crushing the S&P in the early days. And the reason is I had almost 100% of my money in SIN stocks, and they did really well. I bought them on deep discount. And you can see here with Altria, I'm at 19.06% compounded. compound, and I've been in this one since 2009, compounding 19%, that's pretty amazing. Whereas S&P was 14.65 over the same period, which is still amazing. And so that's a takeaway too, is look, at the end of the day, if you don't enjoy stocks, it's not a passion of yours like it is mine. S&P, there's nothing wrong with it. I'm not trying to put down the S&P. For me, I like dividend stocks better because I can skew towards more income. Of the return, there's two components, capital appreciation and a dividend yield or income. I need more yield, I need more income because I want to pay the bills with income. I don't care about capital appreciation. I don't plan to sell. But for someone who might be more of a total return investor or even someone who wants the income component, you can see here, they're pretty close. You may be wondering, Ian, you put in all this extra work and you're only inching out, you know, like a, less than 0.5% better than the S&P. Is it worth it? For me, the reason it's worth it is one, we talked about risk. I like that I have de-risked my portfolio. I believe I have less risk than the S&P. Two, I need the income because I want to pay the bills with my income. I want to reach FIRE, financial independence, retire early. Anyways, Kimberly Clark, it's losing slightly. Actually, I put break even because it's less than a percentage point difference. Southern, losing versus the S&P. Obviously, it's a utility, much less risk than the S&P, so you're going to get a lower return, but it's at a 7.34 versus 12.08. We talked about the simple average. And so at the end of the day, this is how I am beating the S&P 500 barely when I look at my tranche 1 purchases for my top 15 stocks. Now I know, again, people are going to go there and dig into the data. They may arrive at different conclusions. This is what I was able to do, and I think it's indicative. And at the end of the day, the way I interpret this is, look, I'm using the word beat here because I want to illustrate a point. But at the end of the day, I would say they're pretty consistent. Really what it is here is I'm tracking the S&P more or less with my tranche 1 purchases on my top 15 stocks, but I believe I'm doing it with less risk, and I know I'm doing it with a lot more income. All right, everyone, so I want to go through a few statistics here really quickly. I got my, my computer and I got my notebook. Out of these top 15 stocks, two stats I want to share. My average purchase date, when I take the purchase dates of tranche 1, the average is November 1st of 2012. So that gives you a sense of how long these tranche 1 purchases have been in the market. Now, and again, the reason for that is I have sold my portfolio, pretty much the whole thing, twice. And I've done that when we purchased our first home and again when we purchased our second home. So this is the current iteration of the dividend portfolio. And of my top 15 stocks, I have 7 that beat the S&P, 4 that roughly broke even, and 4 that lost against the S&P. And so those are some cool stats. But one thing I want to share is, what are the top 10 stocks in the S&P? Number 1 is Microsoft at a 3.9%. Number 2 is Apple. I own Apple. I love that stock. Number 3 is Amazon. Number 4 is Facebook. I look at Facebook as a riskier stock. Number 5 is Berkshire Hathaway. Number 6, Alphabet. Number 7, Alphabet Class A. Number 8, JP Morgan. Number 9, J&J. Go J&J, my number 1 favorite stock of all time. Number 10, ExxonMobil. What's interesting is when you look at the top 10 stocks in the S&P 500, they comprise 21.8% of the S&P 500. And so the point that I'm trying to make here is a lot of people think I'm buying the S&P 500, I'm de-risking my portfolio because of diversification over all these companies. Quite frankly, it's the top 10 of the S&P 500 make up 20%. And a lot of these companies are riskier companies. They're more volatile companies. When the downturn comes, they will probably grossly underperform the types of stocks that I own. And so that this portfolio, my portfolio, is set up for success in all markets, where I would say the S&P, it's set up for a little bit more success than mine in bull runs, bull markets. And so something worth pointing out, but everyone has different risk tolerances, and my portfolio is an illustration of my personal risk tolerance. So I would be curious, what do you all think of this analysis? I hope it was not too complex. Look, I realize this is probably the most complex video I've done, and so I highly encourage you to download the spreadsheet. Bring your questions here into the comments section below. Let's get a discussion going. The most important message that I can leave everyone with, though, is I'm not trying to say my strategy is the best strategy. I'm not trying to say there are other strategies that don't work. Every single investor needs to find the strategy that works for them. I am literally just sharing what works for me, and I am happy that it is slightly outperforming the S&P based on this analysis, which has a lot of assumptions. But at the end of the day, what it really tells me is, look, I'm there. I'm doing just fine in terms of total return, and I'm doing amazing in terms of the dividend income, which is what matters for me and my aspirations of FIRE. And so thank you for watching today. Thank you for being part of the PPC Ian community. This is a subscriber request video. I take your requests very seriously. Please keep them coming. And if you want to support this channel, please subscribe. I would love to have more subscribers. Interesting stat that I want to share. Here on PPC Ian, there have been almost 2 million video views. Just amazing. And 25,000 subscribers. Would love to see the subscribers increase. I want to build the best dividend investing community ever. And I think we've already got it, quite frankly. And so subscribe, comment, like. That is the best way you can repay me for the analysis today. Now, going into this, one thing I actually want to point before I leave. A lot of people, I get these comments all the time. Ian, you need to get audited by KPMG. I don't trust you. You have these ulterior motives. Look, I'm just going to lay it out there. My only motives for sharing this, quite frankly, is I'm passionate about it. Doing this analysis is good for me to sharpen my own skills. Doing these videos is good for me to sharpen my own skills. So ultimately, it comes out of my passion. Yes, I do earn some income on YouTube for advertisements, but that is the extent of it at this point. I do have aspirations to write a book, and so a lot of people are wondering, Ian, you're getting these email lists. Why don't you just link to the spreadsheet in your description? The reason I do the email list is I want to be able to engage with the community. And by having an email list, it helps me do that. And eventually, when my book is ready, I want to be able to email the people who are interested in dividend investing and maybe interested in checking it out. And from time to time, very infrequently, I like to send emails to the list of pertinent information for dividend investors. It's very rare, quite frankly. It's not many emails that come through. And so I'm just trying to lay it out there. I'm trying to dispel all of these myths. And so if I have an ulterior motive, and maybe even subconsciously I do, the only motive I literally have is I would love to have a bigger email list because I would love to share my book with more people when it is ready. And I would like to grow my subscribers here because it does, quite frankly, feel like a huge accomplishment to have a big YouTube channel. And I like a little bit of the advertising revenue that comes through. But other than that, at this time at least, I don't have a course or I'm not trying to do this or that. And so I just want to lay it all out there because there's people in the comments all the time saying I'm just fabricating it. But literally, I am sharing, I'm just putting all of the data there today. Conclude what you want. You may crunch the numbers and arrive at a different conclusion. This is how I crunched the numbers and I arrived at the conclusion I did. Before I leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed investment advisor first. Literally just sharing my personal journey here on YouTube. In terms of full disclosure, I am long the stocks that I mentioned. I own the stocks that I mentioned today. And some of them I already added the disclosures. I'm going to add disclosures for the one I haven't already. I own J&J, Pepsi, PEP, McDonald's, MCD, United Tech, UTX, Clorox, CLX, Duke, DUK, Realty Income, ticker symbol O, Procter & Gamble, ticker symbol PG, Coca-Cola, ticker symbol KO, 3M, ticker symbol MMM, Starbucks, ticker symbol SBUX, Cedar Fair, ticker symbol FUN, love that company, Altria, ticker symbol MO, Kimberly-Clark, ticker symbol KMB, and Southern Company, ticker symbol SO. I own all of those stocks in my personal stock portfolio. All right, everyone, I'm going to take a break. Hope you enjoyed the video today. I'll see you in the next dividend investing video.